Case study: de-risk your business partnership with life insurance. Have you thought about what would happen to your business and your business partner if you get hit by a bus tomorrow? Would they find it easy to handle the business once you are no longer around? Will there be new stakeholders in the business? And how peaceful and smooth would the transition of these roles and relationships be? I've got a case study for you that will bring to light some of the complications of a business partner passing away and how you can give your business the protection that it needs to withstand a loss of that magnitude. Jiten Patel and Vincent Coelho were two business partners who owned equal shares in an engineering and architectural consultancy that worked with some fairly large projects in the UAE and the GCC region. Jiten, aged 55, is significantly older than Vincent, who is 41 years old. Vincent has two daughters, aged 6 and 8, while Jiten's son and daughter are already in university. They approached me to talk about life insurance. The interest didn't come only from the need to create a cash reserve for their families if they passed away, but also to cushion any potential risks associated with being in a business partnership. When evaluating the future of their business, both partners agreed that if the other died, neither was interested in doing business with the deceased partner's spouse. They were essentially looking for partnership insurance. Partnership insurance is a type of insurance that is commonly purchased by partners in a business. Typically, it involves the partners purchasing life insurance policies in each other's names and naming themselves as a beneficiary. If one partner dies, the other can use the life insurance payout to purchase the deceased partner's share of the business. Both business partners believed that by age 65, they would either sell the business, dissolve it, or step down from being active owners of the company. Let's talk about why it's important to de-risk your business partnership with life insurance. Assume that Jiten and Vincent's business is valued at $2 million. The two of them are equal partners in the business. In a scenario where the company is thriving and doing really well, in the event of the death of one partner, there is a high probability that their shares will be passed down to their next of kin. Likely, the rest of the family may not know how to manage that business. This becomes a very difficult situation for the surviving partner. Business partners, especially active business operating partners like Vincent and Jiten, are key contributors to the business's bottom line. The business's profitability could be significantly affected without one of the key partners. Life insurance mitigates that risk too. So, if Vincent passes away, the life insurance company pays the business $1 million. Jiten uses that money to pay Vincent's family in return for them forfeiting any business ownership. The need to de-risk the families. Jiten and Vincent also wanted to ensure that their families are not significantly affected by the loss of their income in the event of one of their deaths. Each had different approaches to buying life insurance policies for this need as their ages and circumstances differed. Vincent's plan. Vincent, who's 41 years old, had set a budget to buy term insurance worth $2.5 million US. He purchased two life insurance policies for $2.5 million in total, where $1 million was required as partnership insurance coverage and the balance of $1.5 million was purchased as an income replacement for his family. Vincent, age 41, would require to buy the term for 25 years for the policy to run out close to the age of 65. Vincent's wife would receive the balance of $1.5 million to invest wisely so that his income is not missed out. Jiten's plan. Jiten, 55 years old, required just as much, if not more, cover as Vincent. Since he was older with health issues, his premiums would have been higher than Vincent's. But how he approached the purchase of these policies was very different. Jiten needed the same $1 million worth of life cover to protect his business as he was an equal owner. When buying a life insurance policy for his family though, he changed things around a bit. Since he was 55 years old, his term life insurance policy would only have to be 10 years until he reached the age of 65. So he decided that the company's life insurance policy and his personal plan should be purchased for a shorter term than Vincent's. After reviewing various combinations, he structured the life insurance policy for his family by splitting the $1.5 million into 4 policies, each with a different tenure. The longest policy ran until the age of 70. Jiten chose this for personal reasons. So as he grew older, the need for life insurance would be lesser because his investments would pay the dividends, his assets would have appreciated, and his mortgage on his property would have also reduced. This was a great way for him to de-risk his family's finances and business partnership by paying almost the same premiums as a 40-year-old would have. 4 years after purchasing these policies, Vincent decided to sell his shares in the business to Jiten, exit the company, and move to the UK. He couldn't afford to pay his premiums from the UK, so his policies have been cancelled and have since lapsed. As the business sole owner, Jiten has decided to keep the life insurance policy running. If he passes away, there may be nobody to manage the buy-sell agreement, and the equity in the business may not be as much as he thought it was. This is just one example of how life insurance can protect your business. Creating a custom solution for high net worth entrepreneurs is an area of unique ability and expertise for me. I thrive on designing these plans. Reach out to discuss your specific situation and how life insurance and I can help.